Let's talk about the elephant in the room. Well, an elephant you cannot see, private credit. If you walk into a major bank today and ask for a $50 million loan to grow your company, there's a high probability they show you the door. Not because your business is failing, but because the plumbing of the global financial system has fundamentally changed. The banks, they're no longer the primary lenders to the engine of the American economy. Those days are gone. That role has been taken over by a force currently valued at over nearly $2 trillion. The elephant I was talking about, it's called private credit. I just returned from the active exchange in Atlanta. I sat in a room with over 50 of the top institutional allocators who manage billions. The message was clear. The gates are coming down, and today we're doing a deep dive into why the master ledger of finance is being rewritten and how you can finally access this asset class for your own portfolio. Great banker retreat. To understand where you're going, you have to understand why this happened. Since the 2008 crisis and accelerating through the regional banking hiccups of 2023, regulators have put a leash on traditional banks. They told the banks that you can no longer make these type of loans on your balance sheets. It's just too risky. So the banks pulled back. But the demand for the money didn't disappear. Middle market companies still needed to build and hire. This created a vacuum. In the finance, the vacuum is always filled. Private credit firms stepped in. These are non-bank lenders. They don't have the same regulatory handcuffs that they demanded a premium for their capital. And for the first time in history, the structures that hold the loans are open to the individual investor. To understand where we're going, you have to understand why this happened. Since the 2008 crisis and acceleration through the regional banking hiccups of 2023, regulators have put a leash on traditional banks. They told the banks you can no longer hold these type of loans on your balance sheets. It's too risky. So the banks pulled back, but the demand for the money didn't disappear. Middle market companies still needed to build and hire. This created a vacuum. In finance, a vacuum is always filled. Private credit firms stepped in. These are non-bank lenders. They don't have the same regulatory handcuffs. They demand a premium for their capital. For the first time in history, the structures that hold these loans are opening up to the individual investors. Now, this is the technical reasons banks stopped lending. New international standards require banks to hold more rainy day capital against loans, making it unprofitable for them to lend to mid-sized businesses. Because private credit funds aren't banks, they don't have these capital requirements, allowing them to capture the 8 to 12% yields that banks used to keep. So the engine. If private credit is the fuel, then BDCs, or business development companies, is the engine. You'll likely use to access it. In the 1980s, Congress created the BDC structure specifically to allow everyday investors to participate in private lending. Think of a BDC like a REIT, but instead of owning buildings, it owns debt. The BDCs were initially lobbied to Congress's access to help Main Street investors. One rule with BDCs is that at least 70% of their funds have to be invested in these type of investments. Then there's the 90% rule. By law, a BDC must distribute at least 90% of its taxable income back to its shareholders. They're legally required to pass the interest they collect directly back to you. That can create some conflicts in itself, right? Just the forced action that they have to get these returns. Most BDC loans are floating rate. When the Fed keeps rates higher for longer, these companies' pay actually goes up. This is why BDC has recently outperformed traditional bond markets. BDCs were petitioned to Congress. They were part of the Small Business Investment Incentive Act of 1980. And like I said, it was designed to fuel American jobs. Most corporate bonds have fixed rates. They lose value when rates rise. BDC loans have floating rates. The coupon increases as the Fed rate increases, protecting the investor from inflation. But on the downside, those rates go down when rates reduce. Now let's talk about risk. High yield without guardrails is just high risk. When we look at these, we look for 3 specific features. You gotta have guardrails. Where you are in the lending status, this means the lender is at the very front of the line. If a business runs into trouble, the first lien lender gets paid before anyone else. Guardrails, you need to see the NAV, net asset value. That needs to be stable. While stocks bounce around on emotion, the value of a private credit fund should be stable based on the actual value of the loans. We saw this recently with JP Morgan and some other companies in the world reducing the par value of some of their stocks, some of their investments in private credit. Some were 100 and they wrote them down to 0. Some were 100, they wrote them down to 70. Examples like that. So that would affect the price and net worth of these. And then the payment in kind, the PIK ratio. So it means a borrower couldn't pay interest in cash, so he just added to the loan balance. A healthy portfolio keeps this low. You want cash interest. And then the senior secured loan, Secured means the loan is backed by collateral, so machinery, real estate, or intellectual property. Pine and cane income is rising across the broker-dealer or BDC portfolio. It's a red flag that the borrowers are struggling with the cash flow. This is a pro metric that shows that you're watching the fine print. So how do you actually move your capital? You generally have a few doors. You have the publicly traded BDCs. You can buy these on the stock market today. They offer liquidity. They come from market beta. If the broader market crashes, your BDC might drop in price, even if the loans are healthy. Then you have non-traditional BDCs. This is what the big institutions prefer. These do not trade on public exchange fund. They offer periodic liquidity, usually 5% per quarter. They keep the price stable and prevent emotional sellings. Think about what you just heard with people taking money out and it was capped by the guardrails or redemptions. They were seeking redemptions and they were seeking money above the redemptions. Early, maybe you get this 5% redemption from your liquidity event where you're paid. Investors were seeking higher levels. And that was another reason that we saw the flight. Banks having to reevaluate their investments inside of these companies. Some of these companies are tied to software companies with high beta, and just some of these aren't typically the best investments. You have to realize this is a pool and flip investments placed together to create a note. Then you have private placement. This is direct access for accredited investors. It's the purest institutional experience. But your money is typically committed for 3 to 7 years. So you have to remember that. Yesterday I was sitting there and the gentleman on the panel stated that the best way to think about your private equity money is money that you put away and forget about. Because it works best when you let it go out and do the things it's meant to do. These aren't short-term investments. If you need money next week, next month, next year, next couple years, private credit is probably not the way for you to go. But if you have time to go and you're seeking 8 to 12% returns and you can take some of the volatility in the market, then perhaps private credit will be a move for you. Once again, it's not financial advice or blanket recommendations, as everyone needs to look at their own personal financial situation. This is just more of an educational tool for people looking into private credit. There's been a lot of fog and a lot of talk about private credit here lately, and it's just, we want to clear and demystify some of the fog and some of the credit in private credit. Liquidity, that's a big thing, right? Liquidity means that you can get your money when you need it, as I was just speaking. So illiquidity is your money being locked up for those 3 to 7 to however many years it may be. Because this should give you a illiquidity premium. Because you can't sell behind doors 2 or 3. Instantly, the market pays you an extra 2 or 3% in yield, right? You're getting paid to be patient. If you need this money now, you probably shouldn't be investing in private credit. Why are we talking so much about private credit? Because private credit is being accessed into people's 401ks. A lot more investors have reached institutional investor level or accredited investor level, are now worth more than $1 million. So this stuff is becoming more available to the public in general. Like I said, a lot of conversations we had yesterday down in Atlanta were around private credit, the illiquidity. You have to know the fund you're investing in. You need to know the why. A lady on the panel yesterday made a really good point, and this goes for any investment. So for advisors or for people sitting on the other side of the table, you should be able to explain the investment you're in to your client, and your client should be able to explain it back to you. They can't, and they might not be able to get into the minutia, but if they can't explain it high level to you, they probably don't understand it. Private credit is definitely not for those type of people who don't understand what they're investing in. Goes for the advisor too. So be careful when you're digging into private credit. I mean, I see the gap every day. I see the institutional side getting ahead while Main Street is left with the leftovers, you know. One of my missions is to help make sure you have the same blueprint as your giants. You don't need to be in that room in Atlanta to benefit. You just need the right framework, the right mindset. You just need the patience, and you need to know what you're investing in. Am I telling you go invest in private credit right now? No. Do I want you to understand how private credit works so when you see the headlines flashing across TV, you don't panic and want to go sell everything? Absolutely. As I said before, knowledge is power. Understanding why you're invested, where you're invested is such a powerful thing. We've seen the stock market just crash here lately. So oil prices go up, stocks go down. That seems to be a relationship. We don't know how long this will last, but in the long run, stocks tend to go up. That's not being callous to the situation at hand. I just wanted to mention that so people don't run and change everything. So get invested, learn more about private credit. Here's a couple actionable things you can do, right? View your fixed income, right? Is it actually producing institutional grade yields? Like, are you actually getting your money? Check your guardrails. Is your credit exposure first lien? This is if you're in private credit. or anything. What type of debt are you? Where are you at in the debt order? And then stay connected, right? Subscribe to this channel. You can read the Wall Street South Journal on LinkedIn. There are just so many different ways that you can go about it. There are a lot of different things that you can do. We're always looking to bring more things to people. We have the Main Street Meets Wall Street podcast. Currently, there are episodes on the national debt, options trading for investors at all ages. We have crypto. We have events that were current as far as the world, AI's impact. We just cover a wide plethora of things on the podcast. It's a little bit different. This is just me helping the world hopefully learn a little bit more about different topics. Subscribe to the podcast. Check out more videos on YouTube, my YouTube channel. And let me know if there's anything else you want me to talk about. I know we spend a little bit of time on private credit. We have other videos covering things from the One Big Beautiful Bill all the way down to how to open a Trump baby account, a tutorial how to. My channel, Marcus Sturman Sr., is a financial literacy tool for people. And also, for those who are a little bit past that level and want to get a little bit deeper in the daytime, I do have a financial advisory business that I run called the ABC Squared. I am the founder of that business. So remember, we're trying to figure out how to get through this $2 trillion map that's, hidden. That's the ultimate value, is knowledge and understanding. Knowing what you're investing in, once again, is so key. All right, Main Street. Let me know what questions you have. Thanks for your time. I'll talk to you later.